Okay, imagine this for a second. Insurance companies needing their own insurance. Seems a bit circular, right? A safety net for the safety net. We're talking about reinsurance. And it's actually this huge part of global finance. Today, we're not just looking at reinsurance generally. No, we're doing a deep dive into it through a really specific ethical lens, Islamic finance. Okay, let's unpack this. You might find some pretty surprising things here.
Definitely. And to guide us through this, well, we've got a key document. It's standard number 41 on Islamic reinsurance. This comes from AAOIFI, that's the Accounting and Auditing Organization for Islamic Financial Institutions.
And our mission today, we want to cut through the jargon, give you a kind of shortcut to understanding this specialized area. We'll get into the core ideas of Islamic reinsurance, see how it stacks up against the traditional way, and crucially, why it all matters for banks, institutions, maybe even for you. Prepare for a few of those aha moments, I think. So let's start simple. What actually is reinsurance? Just the basics, and then the main event. How does Islamic reinsurance, or takaful reinsurance as it's sometimes called, how does that differ?
Okay, so reinsurance, in simple terms, is insurance for insurance companies. They pass on some of their risk, maybe the really big risks, to another company, the reinsurer. Now, Islamic reinsurance, the takaful reinsurance, it's built differently. It's an agreement where the insurance companies are acting more like agents for the policyholders' funds, the participating insurance funds. The main goal isn't just profit. It's about pooling resources to prevent losses based on cooperation, Talmud, that's the principle. And they set up a separate reinsurance fund, like its own legal pot of money, to provide that cover.
Huh. So less about just selling risk, more about sharing it collectively. That does sound like a big shift.
It is a philosophical one, really. Traditional reinsurance, that's an exchange. Premiums for potential compensation. It's a commercial deal. Islamic reinsurance focuses on mutual support, shared responsibility. It turns risk transfer into, well, collective resilience. And just to be clear, the Standard 41, it digs deep into Islamic reinsurance and how it deals with traditional companies, but it doesn't cover the basics of Islamic insurance itself. That's a separate topic.
Got it. Specific focus on the reinsurance layer, which really brings us to the why, the Shari'ah side of things. What does Islamic law actually say about reinsurance? Is it allowed? This is where it gets really interesting, doesn't it?
Absolutely. And the Sharia ruling shapes everything. So dealing with Islamic reinsurance companies, that's permissible, no question. It fits the cooperative model.
Yeah.
But dealing with traditional reinsurance companies, that's generally forbidden. However, and this is the key nuance, it can be allowed, but only temporarily, as a transitional thing. And the justification has to be general necessity that's basically equivalent to dire necessity.
Dire necessity. Wow, that sounds serious, like a really high bar. What would actually qualify? Is it common or truly a last resort?
It's definitely meant as a last resort. Think of a situation where there are literally no Sharia-compliant reinsurance options available in a market. And not using a traditional reinsurer would cause, significant harm. Maybe the Islamic insurance company couldn't even operate or offer essential cover. It's not about finding a cheaper deal or convenience. It's about preventing collapse or major detriment when no Islamic alternative exists. So yeah, it strongly pushes institutions towards the Sharia-compliant path whenever possible.
Okay, that's crystal clear. Very strict conditions. So we've got the what and why. Let's move to the how. How does this reinsurance actually get structured? What are the practical ways these deals are set up?
There are two main methods, basically. First is facultative reinsurance. Think of it like placing insurance for one specific, maybe unusual risk.
Yeah.
Like a huge construction project or something unique. The insurance company offers that specific risk to the reinsurer, and the reinsurer decides yes or no. It's very case by case.
Okay, tailored for specific risks.
Exactly. Then there's treaty reinsurance. This is more like an ongoing agreement, a standing deal. The reinsurer agrees up front to accept all risks of a certain type that the insurance company writes over a period. Say all their home insurance policies for the next year, it's automatic within the agreed terms.
Right. Facultative is bespoke. Treaty is like a bulk deal. Makes sense. And within those, how is the actual risk shared? Are there different forms?
Yes, there are important forms defining how that sharing happens. Three key ones. First, quota share. Imagine the insurance company gives away, say, 30% of every single policy they write in a certain category to the reinsurer. 30% of the premium, 30% of the risk, and 30% of the claims. It's a fixed slice of everything.
Okay, a straight percentage split on everything.
Yep. Second, surplus reinsurance. Here, the insurance company decides how much risk it's comfortable keeping on its own books. That's its retention. It only reinsures the amount above that retention level. So if they can handle the first $1 million of a policy's risk, they reinsure everything beyond that $1 million. It's about managing the surplus risk they can't easily hold.
So they keep the manageable part, reinsure the rest.
Precisely. And third, excess of loss reinsurance. This is more about protecting against large infrequent losses, catastrophes, basically. The primary insurer pays all claims up to a certain, usually quite high limit, say $5 million per event. The reinsurer only steps in to pay the portion of the loss that exceeds that $5 million limit. It protects the primary insurer from those massive, potentially bankrupting hits.
Okay, so quota share is proportional, surplus is above a certain policy limit, and excess of loss is above a large total loss amount. Very clear. Now, knowing these structures, let's go back to that tricky situation. An Islamic insurance company having to use a traditional reinsurer because of dire necessity. What rules do they absolutely have to follow?
Right. The guidelines are strict, designed to minimize any Sharia noncompliance. First off, they must prioritize using Islamic reinsurers as much as humanly possible. That's rule number one. Second, they're forbidden from holding cash reserves owned by the traditional reinsurer if that setup leads to earning interest, or riba, which is prohibited. However, it is okay for the Islamic company to hold back some of the premium money due to the traditional reinsurer and invest it, but only through specific Islamic contracts like mudaraba, which is profit sharing, or wakala bil istithmar, an investment agency structure.
And how are the profits from those investments handled?
That's key. Any profit generated from the reinsurer's portion of that money goes to the reinsurer's account, but the Islamic insurance company's share of the profit from managing that investment, that goes into the shareholder's account, not the policyholder's insurance fund. It keeps the fund separate and compliant.
Interesting separation. What other controls are there?
Well, any agreement with a traditional reinsurer must only last as long as the dire necessity exists. It can't just become standard practice. And critically, the Islamic insurance company's own Sharia supervisory board has to approve any such deal before it's finalized. They act as a gatekeeper. Plus, the amount reinsured traditionally must be kept to the absolute minimum needed. No more, no less.
Very tight controls. Okay, what about money coming back the other way? Can Islamic firms accept payments like commissions from traditional reinsurers?
This is a really important distinction. They can accept the claim payments, the actual coverage amounts paid out by the traditional reinsurer when a loss occurs. That's fulfilling the reinsurance contract. But they generally cannot accept standard reinsurance commissions or profit shares from the traditional company's surplus. Why? Because those might be generated through non-Sharia compliant means within the traditional system. So what can they do instead? They can ask for a reduction in the premium, the initial price they pay for the reinsurance. It's about adjusting the cost upfront, not taking potentially problematic income later.
That's subtle, but makes a huge difference ethically. It's about the source and nature of the funds.
Okay, let's flip the coin now. What about the Islamic reinsurance companies themselves? What rules bind them, especially if they end up accepting reinsurance from a traditional insurance company? For Islamic reinsurance companies, the rule is simple. Sharia compliance in everything they do. No compromises. Essentially, the same principles that apply to Islamic insurance companies apply to Islamic reinsurance companies. The key focus is always on the policyholders, the original subscribers. And just like the insurance companies, an Islamic reinsurance company must have its own dedicated Sharia supervisory board. This board oversees everything. It set up its contracts, its day-to-day operations, and it issues an annual Sharia compliance report. It's non-negotiable.
So even if they're taking on risk from a traditional player, they have to structure it Islamically on their end.
Exactly. It is permissible for an Islamic reinsurer to accept business from a traditional insurer, but only if certain conditions are met. 1. The contract itself must be structured according to Islamic reinsurance principles. Even if the other party isn't Islamic, the contract form must be. 2. There can't be any problematic financial links like interest-based debt between them. And 3, critically, the actual thing being insured, the underlying risk, must be permissible under Sharia. So an Islamic reinsurer couldn't reinsure a policy covering, say, a casino or a brewery, even if the contract structure was otherwise okay. The subject matter has to be halal.
Right. The underlying activity matters just as much as the financial mechanics. So after navigating all these rules, what's the deal with the financial gains? When an Islamic reinsurance company is profitable, is that legitimate? And who gets the benefit?
Yes, absolutely. Financial gains made by Islamic reinsurance companies operating under these Sharia guidelines are considered legitimate. And here's where the cooperative model really shines. These gains typically go into the policyholder's account. They form part of the income for the participants who contribute to the fund. It directly reinforces that participant-centric cooperative approach. Benefits are shared among the members of the fund.
We've really covered some ground here: definitions, the Sharia rulings, the practical methods, the controls. It's fascinating how Islamic reinsurance isn't just a copy paste of the traditional model. It fundamentally rethinks risk sharing based on these deep ethical principles. It results in this really distinct and carefully regulated financial system.
It really does. And looking at the bigger picture, it's a powerful example, isn't it? It shows how you can design complex financial systems that align with specific ethical or religious values. It proves that alternatives to purely commercial models are viable and can be quite sophisticated, offering different ways to think about finance globally.
It definitely makes you think, how could these principles, cooperation, this strict idea of necessity, Sharia compliance, how could they maybe influence other bits of global finance beyond insurance? Like, what if you applied this kind of rigorous ethical framework to lending or maybe investment banking or even funding development projects? What kind of new ideas or innovations might pop up? Something to chew on, maybe, until our next deep dive.